Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. I know I am a little late in uploading this video, but better late than never. I present to you the CA Intermediate Direct Tax amendments which are brought by Finance Act number 2 of 2024, applicable for May 25, September 25 and January 2026 examinations. Sir, who and all must watch this amendment lecture? Answer: if you have studied from the study material which was applicable for May 24, September 24 or January 25, then this amendment lecture is for you. However, if you have studied from the study material which was relevant for May 2025 examinations, then all the amendments which are going to be taken in this video are already covered in your material Kanna, so it is not necessary for you. However, still I would recommend that everybody must watch this amendment lecture, because I am 100% expecting a question in the examination which will come from these amendments, because these are very important amendments. Fine. So let us begin. Firstly, let me tell you the good news, that is, in which and all chapters there are no amendments at all. So these are the 4 chapters where there are no amendments at all: residential status, house property, clubbing, that is income of other persons included in assessee's total income, and set off and carry forward of losses. So in these 4 chapters you will not find amendments. However, there are small amendments with other chapters which will affect these chapters. For example, house property or set off and carry forward we are going to be discussing in this video. This video is not going to be a lengthy one at all, because major amendments are there only in tax rate and capital gains. In all the other chapters there are only minor amendments which you can cover very quickly. So no problem at all for the students who have studied for Jan 2025 examinations. You will be very easily catching up with the amendments, and very confidently you will be able to attend them in the examination as well. So no need to worry at all. First, let us come to the first chapter. Let us talk about tax rates Kanna. So till the Jan 2025 examination, the previous year that was applicable to you was previous year 23-24, correct? That is year ended 31/3/2024. But now for the May 2025 examinations onwards, the previous year shall be what? Previous year 24-25. That is from 1/4/2024 to 31/3/2025. So the questions that are going to come in the examinations are going to revolve around this previous year only Kanna. So if previous year is 24-25, then what is the assessment year? The assessment year is assessment year 2025-26. So all the tax rates that we are going to study will be for the assessment year 25-26. You get my point? So now let us start with what are the changes in the tax rates. Okay, so first let us talk about the normal tax rates. Okay, that is the old scheme, the normal provisions of the Income Tax Act, or now you can also call it the optional tax regime. Okay, in this what are the changes? Change number 1 is that earlier, it is an obvious change. Earlier, for seeing the senior citizen and super senior citizen, you used to see 1/4/1964, 1/4/1944, but now you should see whether the person was born on or before 1/4/1965 or 1/4/1945, okay, for being a senior or super senior citizen for the purpose of your examination. Now for individual etc., the tax rates are the same, they have not changed at all. Now let's come to company tax rates. There is a small change in domestic company as well as foreign company. For domestic company, earlier you used to see whether the turnover of previous year 21-22 is up to 400 crores or not. Now you should not see 21-22, you should see previous year 22-23, whether the turnover is up to 400 crores or not. Okay, then in foreign company, earlier the rate was 40%, now the rate has been reduced to 35%. So that is a change for foreign company tax rate. Other than that, the provisions are the same, rates are the same, calculation also same. Okay, now let's come to the new tax regime, that is section 115 BAC, which is now also called the optional tax regime. Okay, so in the new tax regime, now there is a change in the slab rates Kanna. There is a change in the slab rates. Sir, so what are the new slab rates? Let us see. So the new slab rates are for income up to 3 lakh rupees, no tax. Income up to 3 lakh rupees, no tax. Income above 3 lakh up to 7 lakhs, 5%. Income above 7 lakhs up to 10 lakhs, 10%. Income above 10 lakhs up to 12 lakhs, 15% tax. Income above 12 lakhs up to 15 lakhs, 20% tax. And see here, there is no 25% slab. There is no 25% slab. Above 15 lakhs, directly 30% tax. So repeat once again, up to 3 lakhs, no tax. Above 3 lakhs, up to 7 lakhs, 5%. Above 7 lakhs, up to 10 lakhs, 10%. Above 10 lakhs, up to 12 lakhs, 15%. Above 12 lakhs, up to 15 lakhs, 20%. And above 15 lakhs, 30% tax. Fine. So this is the new slab rate. So be careful while calculating the tax. You should not calculate with the old slab rates. You should calculate with the new slab rates. Okay. Other than that, what are the changes? Let us see. Okay. When it comes to house property loss, in the new tax regime, we already know that for self-occupied property, interest under section 24B is not allowed as deduction. Correct? Hence, house property loss will not come if it is a self-occupied property in the new tax regime. Fine. Sir, what about let out property or deemed to be let out property? In such case, interest is allowed as deduction. There can be a house property loss. However, you cannot do inter-head adjustment. So, set off of house property loss against any other head of income will not be allowed, and also you cannot do carry forward of loss. So no inter-head adjustment allowed, no carry forward allowed. So house property loss you can set off within house property head of income only, and in the same year you will not be able to carry forward in the next year. Okay, so this is one change. And the other one, generally what happens, Kanna, 115 BAC denies you exemptions and deductions. There are many exemptions and deductions which are available in the old tax regime but which are not available in the new tax regime. But now the situation is a little bit changing. Now there are a few deductions which are not available in the old tax regime but which are available in the default tax regime or the new tax regime. The government wants to make this new tax regime more and more lucrative for people, so that almost everyone will opt for new tax regime only. So what are the three deductions which are higher in the new tax regime? Let us study. First and foremost, in case of salary income, the standard deduction is 50,000 in case of old tax regime, but in new tax regime it is 75,000. Okay, in old tax regime 50,000, new tax regime standard deduction is 75,000. Now, in income from other sources, there is a concept of family pension. Correct? For the family pension, the deduction, the maximum deduction is how much? 15,000. Maximum deduction is how much? 15,000. However, if the assessee opts for new tax regime or the default tax regime, then the maximum family pension deduction also will become 25,000. So the maximum limit is how much? 25,000. Next, even in case of section 80 CCD subsection 2, which comes in the deductions chapter, 80 CCD subsection 2, for employer contribution, the maximum limit was how much? 10%. Maximum limit was 10%. Now it has been increased to 14%. So 10% has been increased to 14%. Okay. So 3 chapters here itself you have covered, Kanna. Salary chapter is covered, income from other sources is covered, and deduction is also covered here itself. Okay. So small amendments only. So 115 BAC. In salary chapter, 75,000 will be the standard deduction for new tax regime. In income from other sources chapter, that is family pension, the maximum deduction will be 25,000 instead of 15,000 in new tax regime. And in national pension scheme or new pension scheme, 80 CCD 2 deduction for the employer contribution will be a maximum of 14%. Okay, you get my point? Now, so these are also over 115 BAC. Now let's come to the special tax rates. In special tax rates, there is a change in the tax rate of capital gains, that is 111A, second, 111A, 112A, 112, and also 115QA, which was for buyback. So all these 4 tax rates have changed. This let us discuss when we are discussing the capital gain chapter. Okay, so together we will discuss. Other than that, no change. In introduction, no change. In basic concepts, no change. For amendments, I have not given a separate notebook for you, Kanna. I have given my entire notes from top to bottom free of cost. I have uploaded it in the Google Drive, and the Google Drive link I have shared it with you. Okay, so you can go to the Google Drive link, download the entire notes. Whatever amendments are there are marked in grey color in italics. So if you see, for example, so whatever amendment is there will be in this style, will be in italics and will be marked in grey color. So you can easily identify the amendments while you are going through the notes. Fine. Next, in basic concepts, there is no change. Residential status chapter, no change. Exemptions, no change. Then salary, we have already seen the amendment which was for standard deduction, correct? That is 75,000 is the standard deduction which is available under section 115 BAC. Other than that, in salary there is no change. However, I want you to be careful while you are doing the calculation of rent-free accommodation. Last time in May 24 to Jan 25 examinations, while you were studying, you had studied the transition provision. So for half of the time one rate was there, and for the other half of the year the other rate was there. But now the transition provision is over, so now for the entire year it has become easier, Kana. There is only one rate. Okay, so be careful while you are seeing the rent-free accommodation part. I want you to go through this carefully and even work out the questions if possible, so that you are strong in this concept. This also can be tested in the examination, because one of the favorite question for the examiner to ask. Okay, so other than that, in salary chapter, no other change. Now let's come to income from house property. Okay. There is a change in PGBP chapter, Kana, profit and gains of business or profession, which is also affecting the house property chapter. So first let me tell you where the change is there in PGBP chapter. So you will automatically be able to adapt it to the house property chapter. See here, come to PGBP. In section 28, that is the charging section of PGBP, there is a small change. If an assessee is engaged in the business of letting out of residential houses, income from such letting out shall not be chargeable under PGBP and would be chargeable under house property. Income from such letting out. Please cut these two words. Okay. Income from such letting out will not be chargeable under PGBP but would be chargeable under house property. So what does this mean? For example, there is an assessee, Mr. A. Mr. A is having 3 houses. Okay, and all the 3 houses are given on rent, and these 3 are residential houses. Earlier, there was ambiguity. Ambiguity or confusion whether this rental income will come under house property or it will come under PGBP. Then there were some Supreme Court cases and Madras High Court cases which told that if the assessee has business of giving houses on rent, then it should come under PGBP chapter. It will not come under house property chapter. Okay. So hence earlier we were learning that the business of letting out of properties will always come under PGBP chapter. But now there is a small change. If the business is itself giving houses on rent, and if such houses are residential houses, then the income will be treated as income from house property and not PGBP. It will be treated as income from house property and not PGBP. Sir, but what if instead of residential house it is commercial property? Let's say they are shops. If they are shops, then it will be treated under PGBP only, Kanna. So let me explain you the example once again in brief. So there are three properties. Let us assume that all the three properties are residential houses. So if Mr. A's business is giving this residential house on rent, then also it will be treated under house property only because of the new amendment. However, instead of residential houses, if these three are shops that are given for rent, then it will come under PGBP chapter. You get my point? So house property change is also covered, PGBP also covered. Other than that, in house property, no change. Now let's come to the other changes in PGBP. Other than that, I don't think there is any other change. Yes, in section 36, I told you about 80 CCD subsection 2, that is employer contribution deduction has been increased from 10% limit to 14% limit, correct? The same change will reflect here also in section number 36. Even the employer will get a deduction of up to 14% of the salary, okay? Other than that, I don't think there are any other changes. Yes, section 40B. Section 40B, where we study the deduction that is given to the partner of a partnership firm. So earlier, what were the limits? That if the book profit was up to 3 lakhs, the maximum amount of salary allowed will be 1,50,000 or 90%, whichever is higher, and the balance book profit 60% will be allowed. But now the limit has doubled. Instead of 3 lakhs, now it has become 6 lakhs, and instead of 1,50,000, now it has become 3 lakhs. So now when you calculate, you should calculate using the new limits, okay, for section 40B. So PGBP, I think that's all. No other change. Now let's come to capital gain chapter, Kana. Important, very important, very, very important. Definitely question is going to come in the examination, which is going to test these provision, and moreover you are the batch which is stuck in the transition provision. So you have to learn the before also, you have to learn the after also, both you have to study, and if anything happens before the cutoff date, you have to apply the old provision. If anything happens after the cutoff date, you have to apply the new provision. So both old as well as new provision you have to study. Income tax is like that only, Kanna. So what are the changes? Let me tell you. Firstly, let us come to the easy change, that is cost inflation index. So cost inflation index for previous year 24-25 is how much? It is 363. So if any transfer takes place in previous year 24-25 and you want to find the index value, you have to use the index as 363. Okay, so that is the change. Then let us come to transactions not regarded as transfer. Section 47, transaction not regarded as transfer. There is a clarification that I had told you that gift or irrevocable trust will not be considered as transfer. However, this point is applicable only for individual and HUF. It is applicable only for individuals and HUF. Okay. Now let us come to short-term capital asset versus long-term capital asset. Short-term capital asset versus long-term capital asset. Karna, earlier there were three categories to define what is short-term. Okay, one was 12-month category, one was 24-month category, and one was 36-month category. In 12-month category, what did you study? Listed securities except units. Then units of equity oriented fund, unit of UTI, whether it is listed or not, and then zero coupon bonds. They were considered as short term up to 12 months. More than 12 months, it will be considered as long term. Then when it came to unlisted shares, land and building or both, it was considered as short term up to 24 months. More than 24 months, it was considered as long term, and all the remaining capital asset up to 36 months considered as short term, more than 36 months considered as long term. Okay, but now what is the change? And the change is from the budget date kanna, that is 23/7/2024. Important, very important, very important date that you have to memorize is 23/7/2024. If any transfer is taking place on or after 23/7/2024, then the concept of long term will change. Now from 23/7/2024 onwards, there is no concept of 36 months. There is no concept of 36 months. There is only 24-month category. So the 12-month category is same as it is, and all the other capital assets will be included in the 24-month category. There is no 36 months category. And there is one more small change. In the 12-month category, earlier there was the words used except units. Okay, so in case of listed units, it was not considered as short term even if it was listed within 12-month period, and long term after 12-month period. However, now the word except units have been removed. Except units have been removed with effect from 23/7/2024 onwards. Okay, so before 23/7/2024, listed units other than equity oriented fund and UTI, because equity oriented fund and UTI units, whether they are listed or they are not listed, they will be considered in the 12-month category only. But however, listed units other than equity oriented fund and UTI, this is up to 22/7/2024 from 23/7/2024. So up to 22/7/2024, it was coming under 36-month category. From 23/7/2024, it is coming under 12-month category. So this also is a change in the 12-month category. Okay, and now there is no 36-month category at all. There is only 12 or 24. Fine. So if the transfer takes place before 23/7/2024, there are 3 categories kanna: up to 12 months, up to 24 months, up to 36 months, which you have already studied. But if the transfer takes place on or after 23/7/2024, then there are only 2 categories: up to 12-month category, up to 24-month category. So more than 12 months will be long term in the 12-month category. More than 24 months will be long term in the 24-month category. Okay. So long term, short term, it is a major change. Then other than that, what is the change? There is a major change in indexation. Major change in indexation. What is the major change? From 23/7/2024 onwards, for long term capital gain, for long term capital asset, no indexation will be allowed. The concept of indexation itself is removed from the Income Tax Act with effect from 23/7/2024. So if the transfer takes place before 23/7/2024, and if it is a long term capital asset, you have to apply the indexation concept. But if it is on or after 23/7/2024, there is no indexation concept at all. Sir, but we have also heard that for land and building, if there is a transfer, then indexation benefit will still be allowed. Answer is yes, Kanna. Indexation benefit is allowed, but it will not be allowed through indexation section. It is allowed through the tax rate section, which we will be discussing in a few minutes. Okay, so indexation definitely is not allowed whatsoever from 23/7/2024 onwards. You get my point? So before 23/7 normal indexation, from 23/7/2024 onwards no indexation. So be very clear with that. So how will you calculate capital gain? Just like how you calculate the short term capital gain, same way you will be calculating the long term capital gain also. Okay, so first you will be taking the sale price, that is full value of consideration. From this you will be reducing the transfer expenses. Okay, after that you will get net consideration. From this you used to reduce indexed cost of acquisition and indexed cost of improvement, correct? So up to 23/7/2024 you will be calculating indexed cost, but from 23/7/2024 onwards no indexation, hence directly you will take cost of acquisition and cost of improvement and find out the capital gain. Okay, in this video I am just covering the amendments quickly. I will try to come up with another video where I am taking a capital gain example, and I will try to cover what are the provisions before 23/7/2024 and from 23/7/2024 onwards. Okay, in a separate video. So this is the indexation concept, so no indexation benefit. Now let's come to tax rates. After tax rates we will discuss buyback. Tax rates, first let us discuss tax rates, after that we will discuss buyback. Okay, so what are the new tax rates now? So the tax rates also have changed from 23/7/2024 kana, that is the date of the budget. So before that you have to study the old tax rate. If the transfer takes place from 23/7/2024 onwards, you have to study the new tax rate. So both you have to study kana. So in case of 111A, short term capital gain, in case of equity shares, unit of equity oriented fund and business trust, okay, on whom STT is paid on transfer, what is the tax rate? 15%. It was 15%. Now it has been increased to 20%. It has been increased to 20%. So transfer before 23/7 15%, on or after 23/7 20%. You get my point? Next, long term capital gain. Now let us study section 112A. 112A, long term capital gain in case of equity shares of a company, units of business trust, equity oriented fund on whom STT is paid on transfer, and in case of equity shares STT should be paid on acquisition as well as transfer. Okay, what is the tax rate? Earlier the tax rate was 10%, and last year you would have studied a limit of 1 lakh. 10% above 1 lakh, but now the 1 lakh limit is not there, whether it is before 23/7/2024 or after 23/7/2024. The limit will be how much? 1,25,000. 1,25,000. So up to 1,25,000 long term capital gain, no tax kana. Above 1,25,000, on the excess value alone, it is 10% if the transfer took place before 23/7/2024, and 12.5% if the transfer took place on or after 23/7/2024. You get my point? And in both cases the limit will be 1,25,000. Now let's come to section 112. Very important, and I think if the examiner wants to give a challenging question, definitely they will try to test section 112 in the examination. So important from the exam point of view, in my opinion. In May 25 I am expecting a question from this section. If it is not coming, definitely it is going to come in September 25, but I think it will come in May 25 itself. Okay, so section 112, tax on long term capital gain. Normally what is the tax kana? Normally the tax is 20%. So listen here, 111A, 112A and 112. In 111A, earlier the tax was 15%, it is increased to 20%. Okay. In 112A, earlier the tax was 10%, it is increased to 12.5%. percentage. Correct. In 112, that is general long term capital gain, that is long term capital gain other than 112A. Okay, what was the tax rate earlier? 20 percentage, but now it has been changed to 12.5 percentage. So here the assessee will be very happy, correct, that the tax rate has finally come down. In other section it is increased, but in section 112 it has come down. But however, there is one thing which will make the assessee sad also, that in this 12.5 percentage, if you are calculating, then there is no benefit of indexation, as I told you earlier. So this 20 percentage was with indexation, but 12.5 percentage new tax rate from 23/7/2024 onwards, there is no indexation. There is no indexation. Okay. So see here. So 20 percentage, it was 20 percentage before 23/7/2024, 12.5 percentage from 23/7/2024. However, here there is no indexation. Okay. Here also all others I have written 20. You please change it as 20 percentage before 23/7/24, 12.5 percentage from 23/7/24. So it is not only for resident, individual and HUF, it is for everybody. Okay. Now for any non-resident or foreign company, and if their long-term capital gain was from unlisted shares or shares of closely held company, earlier the tax rate was 10 percentage without indexation. Now it has been changed to 12.5 percentage without indexation. So before 23/7/24 it was 10 percentage without indexation. From 23/7/2024 it is 12.5 percentage without indexation. Okay. Next. Yes, here also this concept of long-term capital gain, earlier if there was long-term capital gain from listed securities other than units and zero coupon bonds, the tax rate was 10 percentage without indexation or 20% with indexation as per the choice of the assessee. However, from 23/7/2024 onwards, this concept has been removed. Now this concept is not there. Okay. Now let us come to the indexation benefit that is given to immovable property. Kanna. Indexation benefit that is given to immovable property that is transferred even on or after 23/7/2024. Okay. Listen here. Immovable property, it was sold before 23/7/24, and if it is sold on or after 23/7/24. So earlier what was the concept? Earlier indexation was allowed. Okay, you could also take the benefit of fair market value as on 1/4/2001, because index starts from 1/4/2001 only, correct? So you would take the higher of cost of acquisition, that is actual purchase price, or fair market value as on 1/4/2001, whichever is higher, correct? So that benefit was there, and the rate of tax and capital gain was 20 percentage. Sir, what about now? And there is also concept of stamp duty value as on 1/4/2001. Those provisions are also the same. Now, sir, what about fair market value as on 1/4/2001? And here I am not talking about house property alone, I am talking about all the capital assets. If you had purchased a capital asset and it was long term, purchased before 1/4/2001, you could take the benefit of taking the purchase price and purchase price or fair market value as on 1/4/2001, whichever is higher. Sir, is that concept changed? Answer is no, Kanna. Still that concept is the same. Okay, so even on or after 23/7/2024, if you are transferring any capital asset and if it was purchased before 1/4/2001, you can still take the benefit of actual cost price or fair market value as on 1/4/2001, whichever is higher. Okay, so that benefit is still allowed. Now there is no indexation. No indexation, and the rate has been changed to 12.5 percentage. Rate has been changed to 12.5 percentage. So after this change was announced in the budget, there was a lot of hue and cry in the market, because especially for house property, that is immovable property, whenever it was transferred, indexation was a very very big factor while calculating the capital gain. So many people started complaining to the government that we want indexation benefit on the houses, we do not want the new tax rate, that is lower tax rate, we do not want, we want the higher tax rate itself, that is not a problem, but we want indexation benefit, because due to indexation the cost of acquisition becomes indexed cost of acquisition and the capital gain becomes smaller. Since the capital gain is smaller, then very low tax is only payable on the capital gain. So people requested the government, and the government partially listened to the request, but partially did not listen to the request. Okay, in a way the government fooled the taxpayers only. I will tell you how. The government told that we will not bring back indexation at any cost, hence indexation is removed forever. Now it is not going to come back, but only to give relief. The government told that while calculating the tax, not while calculating the capital gain karna, while calculating capital gain there is no indexation at all. Please remember this very very carefully. But while calculating the tax, when you are calculating under section 112, then the government has given an option to take 12.5 percentage without indexation or 20 percentage with indexation, whichever is lower. 12.5% without indexation or 20 percentage with indexation, whichever is lower. So now this benefit has been given, only subject to conditions. What are the conditions? Let us see. There are three conditions karna. What are the three conditions? Number 1, the assessee shall be a resident individual or HUF. So for companies, firms, non-residents, this provision will not apply. So for corporates who are doing real estate business etc., for them this concept is not applicable at all. If there is capital gain, okay, then there will not be any indexation. Even in the tax there will not be any indexation. So first condition is what? Assessee should be resident individual or HUF. Second condition, immovable property should be a long-term capital asset. Obviously, because for indexation you need a long-term capital asset, correct? It should be a long-term capital asset acquired on or before 23/7/2024. Acquired on or before 23/7/2024. So what is our finance minister telling? Our finance minister is telling that only since you are upset when I announced it in the budget for your before properties, you will not get the benefit of indexation. However, since now you are knowing that I am not going to allow indexation, in future purchases I am not going to allow this indexation benefit. So listen here. Let's say if I purchase a property on 1st August 2024, okay, and if I am selling selling this property on 31st of August 2028, is it a long-term property? Answer is yes. In the tax rate, will I get indexation benefit? Answer is no, since the purchase of property was made after 23/7/2024. You get my point? So this benefit will only be applicable if the property was purchased before 23/7/2024. Fine. Next, the transfer shall take place on or after 23/7/2024, because before 23/7/2024, however, you are getting the indexation benefit, so no problem at all. only on or after 23/7/2024 there is the confusion or there is the denial of benefit of indexation, hence it will be given in section 112. Okay, so if all the three conditions are satisfied, then what is the benefit given? While calculating the tax under section 112, the assessee has a choice. What is the choice? He can take 12%, 12.5% without indexation, 20% with indexation. Okay, whichever is lower. So pay the lower tax and get the benefit. Sir, so actually is the benefit of indexation given to the taxpayer? Yes or no? Is the benefit of indexation given to the taxpayer? First and foremost, they already put some conditions that it should only be resident individual HUF, the property should be purchased only before 23/7/2024, then only this benefit will be given. But by smartly not reintroducing indexation but introducing this benefit in the indexation in the tax rate section, the government has done one big loss for the assessee. What is the loss? Listen here, come. Let us assume for simplicity's sake, the selling price of a house is rupees 1 crore. Okay, cost of acquisition is 30 lakhs. Cost of acquisition is 30 lakhs. Indexed cost of acquisition after doing indexation, let us assume it is coming to 150 lakhs. Cost of acquisition 30 lakhs. Indexed cost of acquisition 150 lakhs. Selling price is how much? 100 lakhs. Okay, selling price is how much? 100 lakhs. Now, before 23/7/24, what used to happen? Full value of consideration will be taken as 100, correct? Minus transfer expense, you will get net consideration. From that, you will reduce indexed cost of acquisition, which is 150, and you will get long-term capital loss of 50 lakhs. You will get long-term capital loss of 50 lakhs. But listen very carefully. And what will be the tax? Tax under section 112 will be 0. Since there is no capital gain, so there will not be any tax. Correct? On or after 23/7/2024, now what has happened? Listen. Full value of consideration is 100. Cost of acquisition is 30. Then long-term capital gain is how much? It is 70 lakhs. Long-term capital gain is 70 lakhs. Then you will calculate the tax under section 112, which is how much? 12.5%. 12.5% of 70 lakhs or 20% of minus 50 lakhs. So you can't have a negative figure in tax, so you will have the tax as 0, correct? And 12.5% of 70 lakhs is how much? 70 into 12.5%, 8.75 lakhs. So one benefit is that the assessee can now choose 0 as the tax and need not pay any tax on capital gain, which is very, very good. However, now see here, earlier the assessee used to take the benefit of this long-term capital loss. He will set off this long-term capital loss with his long-term capital gain. If he cannot set off, he will carry forward this long-term capital loss for 8 more years, and then he can take the benefit of set off in the future years. But now what has happened? He cannot. There is no loss at all, Kanna. Since there is no loss, what will he carry forward? He cannot carry forward anything, because from 23/7/2024 onwards, there is a gain of 70 lakhs. So there is no question of loss. So now the benefit of loss has been denied to the assessee. You get my point? One more point I will tell you. Let's say other income is equal to 40 lakhs. Other income of the same assessee is 40 lakhs. So when other income is 40 lakhs, what will happen? If the transfer was before 23/7/2024, before 23/7, listen very carefully. This is a conceptual thing that you need to understand. If you are understanding, things will become very easy for you to solve. Okay, before 23/7/2024, what will be the position? Other income will be, let's say, 40 lakhs. Long term capital loss will be minus 50. You cannot set off both with each other, hence this will be carry forward. So the total income will be how much? 40 lakhs, and you will calculate the slab rate on 40 lakhs. You get my point? Very clear. Now what happens? Other income is 40 lakhs. Okay, capital gain 70 lakhs, because indexation has been removed. The change has only been brought in the tax rate section. So the total income will not change karna. So what is the total income now? Total income is 110 lakhs. 110 lakhs. So now the assessee on 112, there will be no tax, 0% tax, because the benefit has been taken under 112 to pay the lower tax as per indexation benefit. However, in slab rate, when the tax is calculated, you also have to calculate surcharge karna. You also have to calculate the surcharge, because the income is more than 100 lakhs. Since the income is more than 1 crore, surcharge will be applicable. Correct? Surcharge will be applicable. So you have to calculate surcharge on this tax. So this is also one loss that is happening to the assessee after because of this change. Okay, indexation is not reintroduced. Indexation benefit is not available at all. It is just given in the tax rate section. In the total income section, in the total income side, there is no change at all. There is no indexation benefit. One more loss to the assessee, let me tell you. Now let us imagine that after indexation, I am taking another example. Okay, let's say after indexation, the capital gain comes to 10 lakhs. Okay, before indexation or without indexation, without indexation. Here we will keep with indexation, so you will not get confused. With indexation, the capital gain is 10 lakhs. Without indexation, the capital gain is 60 lakhs. The capital gain is 60 lakhs. But now you know what will happen. When you are taking the benefit under section 54 series exemption, 54 series exemption, if you are taking, you have to invest the amount of capital gain in the new property. In such case, since after 23/7/2024 there is no benefit of indexation, you will always see the capital gain without indexation only. Okay, indexation benefit is available only in the tax rate. It is not available in the total income. Okay, or while calculating capital gain, there is no benefit of indexation. Hence, for this 54 series exemption, for investment purpose, you should consider this 60 lakhs and you should not consider this 10 lakhs. So this is also one loss which is there for the assessee. So even though indexation is reintroduced, first and foremost, it is reintroduced with some conditions. That is, it is only for resident individual and HUF. It is only for property which was purchased before 23/7/2024. Moreover, it is a benefit which is given only in the tax rates column. It is not given in the income column. Okay. Just a second. I hope you are clear. Just a second. Yes, I hope you are clear. So 3 places where you should remember that benefit of indexation is not available. One place is that now for set off and carry forward of loss, the benefit will not be available. For calculating the surcharge, the benefit will not be available, and also while calculating the 54 series exemption, okay, the benefit will not be available. I hope you are clear with the provision. Other than that, what are the changes? Okay, we will come to buyback. Buyback also transition provision karna. So you have to study what is the provision before the cutoff date and on or after the cutoff date. Here the cutoff date is not 23/7/2024. Even after the budget, the finance minister had allowed some time for the old provisions. So if any companies were planning a buyback, they could have done with the old provision itself, and thereafter new provision will come. So from when did the buyback provision change? Buyback provision changed from 1/10/2024. Very, very important. It changed from 1/10/2024 onwards. Okay. So up to 30th September 2024, what was the provision? If there is any domestic company, it can be a listed company also, it can be an unlisted company also. If the domestic company was buying back its own shares, then while giving the money to the shareholders for the buyback, it has to pay a tax of what? 20% plus 12% plus 4%. So 20% tax plus 12% surcharge plus 4% health and education cess, it will come to 23.296%. And how to calculate the buyback tax? So the buyback tax will be on the buyback price. Buyback price will be total buyback price minus issue price including premium. So buyback price minus issue price including premium, you will get the value. On this value, you have to calculate 23.296%. The company will deduct the tax, it will pay to the government as buyback tax, and balance amount it will give to the shareholders. Sir, then what about the shareholders? In the hands of shareholders karna, this entire amount will be exempt under section 1034A. Under section 1034A. Now what happens? From 1/10/2024 onwards, the concept of buyback has changed. Now, even if a domestic company, whether it is listed or unlisted, does not matter. If a domestic company is doing buyback, then no tax has to be paid by the company. No tax has to be paid by the company, but the entire value of buyback will be considered as deemed dividend. Entire payment on buyback. So no deduction and all. Entire payment which is received from buyback from the company will be treated as deemed dividend under section 222F. So this is only the change in income from other sources chapter. In income from other sources, there is a section called clause 22. Okay, A, B, C, D, E. You have already learned. There is now a new subclause, that is 222F, which is deemed dividend from buyback. So any payment received from the company on buyback will be considered as deemed dividend. No deduction will be allowed. No deduction will be allowed. Okay. Now, since no deduction is allowed here on buyback, then the shares are also given to the company, correct? Shares are also given to the company. So from the point of view of the shareholder, it is a capital gain. Listen here. Let's say DC is a domestic company, okay, and SH is the shareholder. Now we are talking from 1/10/2024 onwards. What will happen? From 1/10/2024 onwards, let's say DC gave money to the shareholder. Shareholder gave back the shares. So this is only buyback, correct? Now in this money, there earlier used to be tax of 23.296%. Now there is no tax. Correct? Now the shares are given to DC for which the money is received. So this money is treated as deemed dividend under section 222F under income from other sources in the hands of shareholders. Okay, let's say this share was purchased by SH at 1000 rupees. Okay, and for buyback this person is getting rupees 10,000. Rupees 10,000. Now, while the amount is received in the hands of shareholder, the entire 10,000 rupees is treated as deemed dividend. Sir, but the cost of the shares should be reduced, correct? Because actually the person is getting how much? Only 9,000 rupees, because for 1,000 rupees the shareholder had bought the shares. Since the shareholder had bought the shares for 1,000, he is getting total 10,000. His income is only 9,000, correct? But here entire 10,000 will be treated as deemed dividend. Entire 10,000 will be treated as deemed dividend in income from other sources. Now, see here, the shareholder has given the shares to the company, correct? So this is a transfer of shares. In the case of transfer, capital gain will arise, correct? So how to calculate the capital gain on the shares that is given by the shareholder to the company? So full value of consideration. Here the government has given a benefit. Actually the full value of consideration should be how much karna? It should be 10,000. But this 10,000 is being taxed under income from other sources. Hence the Income Tax Act is telling, don't take this 10,000 as full value of consideration. Instead, take the full value of consideration as nil. You get my point? Take the full value of consideration in buyback as 0. Then minus cost of acquisition, which is how much? 1,000 rupees. So capital loss, it can be short term or long term. The capital loss will be how much? 1,000. Capital loss will be 1,000. You get my point? So here there will be a deemed dividend of the entire value in income from other sources, and the cost alone will form part of loss, capital loss. So both working you have to do karna. Capital gain working also you have to do in case of buyback. You have to do the deemed dividend working also in case of buyback. Okay. What will be the period of holding for the capital gain calculation? From the date of acquisition till the date of buyback. That will be the period of holding. Okay. So these were the important changes in the capital gain chapter. Now in income from other sources chapter also, section 222E only was the important change, which we have already discussed, and also against this 222F is the important change, and against this 222F no expense will be allowed. That also you have to remember. This family pension higher limit of 25,000 we have already discussed. And for dividend income other than 222F, there are deductions that are allowed, but for 222F no deduction is allowed. Next, for clubbing there is no change. For set off carry forward there is no change. In deductions also there is only a small change in 80CCD subsection 2, which we have already discussed. That is that 14% in case of employer contribution. Where is that? Yeah, here you can note down 80CCD subsection 2 employer contribution. Now the limit has been increased only in section 115 BAC to 14%. Okay, under the normal regime it is 10% only as usual. Other than that, in deduction chapter there is no change. Okay, now let's come to TDS chapter. Other than capital gain, TDS chapter only has the majority changes. Okay, so what are the changes? Firstly, let us come to section number 192. Section number 192, that is TDS on salary. One small update only. In TDS of salary, earlier the employer used to consider the other incomes of the assessee, other TDS deducted for the assessee. Now the employer should also consider the TCS deduction that has taken place for the assessee. So for example, there is an employee has purchased a car of more than 10 lakhs. So 1% TCS has been collected from the employee. Now when the employer is deducting TDS on salary, employer is deducting TDS on salary, this employee will tell 1% TCS is already collected by the car owner, so that much less TDS you deduct on salary. So employer will reduce the TDS by this TCS amount, so that there is no double tax. Only the TCS will be adjusted in the salary TDS calculation. Okay. Next, in section 194, just a minute. Again, what problem happened? Just a second. Okay, listen. In section 194A, there was a change which we discussed earlier itself. That is, interest on Mahila Samman Saving Certificate also, TDS need not be deducted. Then, other than that, what are the changes? Let us see. Okay. In section 194DA, actually in 5 sections, the rate of TDS or TCS has changed. Okay, in 5 sections. And for all of them, the cutoff date is what, sir? The cutoff date is 1/10/2024. Buyback also it is 1/10/2024, and for TDS chapter also it is 1/10/2024. So from 1/10/2024 onwards there is a new rate. Before 1/10/2024 there was old rate. So you have to consider both rates while doing the calculation, since you are in the transition provision. Okay. So for all the payments before 1/10/2024 old rate, on or after 1/10/2024 new rate. Okay. So for 194DA, the rate has changed from 5% to 2%. Okay. Next, for 194G also, it has changed from 5% to 2%. For 194H, very important, this can be tested in the exam also. It has changed from 5% to 2% from 1/10/2024. 194IB also, it has changed from 5% to 2%. Okay. Then 194M also, it has changed from 5% to 2%. So these are the 5 sections where changes were there. Other than that, in capital gain chapter, in TDS chapter, I don't see any other change. Other provisions are the same. Okay. Now let's come to the last chapter, that is return filing return of income. Here also there is only one small change, that earlier wherever you used Aadhaar, you could also have used 28-digit enrollment ID. But now wherever Aadhaar is compulsory, you can quote only the Aadhaar number. You cannot quote the 28-digit enrollment ID. Okay. 28-digit enrollment ID now not allowed, only Aadhaar number is allowed. So that is one change. Fine. So with this, all the amendments for May 2025 examinations are over. Not many. So this lecture itself was only for 1 hour or so. In 1 hour we have completed all the changes. So update with these amendments. If you are using the old book, whatever changes I have told you, you could note down in the old book itself, or else I have provided you with the new notes. You can take a printout of the new notes and you can study from the new notes. Fine. So I wish you all the best of luck, Kanna, for your examinations. I will try my best that I will try to put out more resources if possible. Also, I will be taking a batch, fast track batch in Chennai from 4th of April onwards till the 8th of April. You could find the details of the batch in Tarun's Brainery, that is Tarun Sir's channel. So if you are interested, you can join there, and I will see you in Chennai. Okay, it can be face to face as well as online live. So see you in the next video. Till then, take care. Bye bye.